Okay, let's begin. Good evening, everyone, and thank you for carving out some time this evening to join us in the Wildfire Insurance Recovery webinars that we have had going. This is the sixth of eight webinars that we have held every week, Wednesday evening at 6:30 p.m. And the reason these exist is to help people help themselves through understanding the anatomy of a claim, how to successfully recover whatever you're owed from your insurance policy / contract. We hope that this information is useful, and the time that you spend with us is well worth it. Just a little introduction on myself. My name is Rino Benenati. I have been a public adjuster, public advocate, going on 31 years now. It's been a long career. And I have been involved in every firestorm in recent history, so well-versed in how these things work. I have seen, unfortunately, all too often, year after year, these firestorms happening all over the country and up in Canada as well. And it seems to be pretty prevalent, and it used to be once in a great while, and now it's happening much more frequently, unfortunately. Greenspan itself is the oldest and most respected public adjusting firm in the United States and Canada. We have been in the LA area for 79 years, so we have a huge footprint in the LA area. And these webinars are our way of giving back to the community who has supported us for so very long. And we hope that the information is useful. But before we begin, we want to acknowledge the incredible devastation and emotional burden and toll that this firestorm has taken. It does not go unnoticed, and we're sharing our 79 years of representing policyholders will hopefully ease that burden by allowing you to have access to our knowledge and our information and the way it's disseminated, so that you can understand how these policies / contracts should respond and will respond to your losses. Now, obviously, everybody has different situations, but in general, globally speaking, these slides that you will see are how these policies are to respond. Now, with that said, let's begin. So first of all, we want to cover some common misconceptions that happen, and here's a couple of big ones. I have a policy and I paid my premiums for years. My policy limit is X, whatever that number is. This is what the insurance company will pay me, right? Well, in a perfect world, that would be great, and my industry wouldn't exist if that was the case. But the fact of the matter is that you have to prove what your damages are. You're the claimant, not the insurance company. The insurance company has the money to pay the claim, but simply having a policy and paying your premiums does not guarantee you will receive the full policy limit without justification. Well, what does that mean? We all know you've suffered a loss, but you have to put a claim together as a claimant, and you need to defend that claim. And by defending it, meaning putting together a detailed report of what it is that they owe you. And we're going to be covering how to do that in these slides ahead. So that's important to understand. Again, I'm going to repeat it. You're the claimant, not the insurance company, and the burden of proof lies upon your shoulders. The other misconception we hear a lot is my insurance is being really cooperative and they have put me in a temporary residence. Well, the insurance company is legally obligated to provide these advances and accommodations per your policy. Now, it says policy contract. Those words we're going to use interchangeably because the policy is a policy and it turns into a contract, so to speak, the minute you activate it with a claim. And so you're subject to the conditions and definitions, the exclusions, all the verbiage in the contract. So you're subject to that, and the insurance company is as well. It is a contract in essence. And so you want to operate, and they need to operate within the four corners of that contract. So if you hear me say contract, it means policy. If you hear me say policy, it's a contract. So again, those two words will be used interchangeably. But before we begin on the next slide, I want talk about a couple of things that are very important. I have spoken to a few hundred people. These are inbound calls that come in, and probably 30% have no idea how the policy, what the limits are. So I urge you all to order a certified copy of the policy. Certified is not how they mail it. Certified copy comes in from underwriting. It takes a couple of weeks. And the reason you want to order a certified copy is it'll show the current language and endorsement changes that may have occurred over the policy period. Your policy goes from one year to the next, and sometimes in the middle of that year, the insurance carriers change the language of the contract. And they'll send you this one pager, you'll get it mailed or emailed, and here's a California endorsement change. And most people just stuff it in the drawer. Well, now you need to understand what that change was and how it affects your claim. So again, order a certified copy from your adjuster, request it, and a lot of people have gotten theirs. Others have don't even have the policy, and they're leaning on the insurance adjuster for all the information. Well, look, folks, they're not in the business to teach you how to get more money out of them. And that's why we're having these webinars. So it's really important to order a certified copy of the policy. The slides moving forward will be talking about total losses as well as smoker losses. After the slide presentation is over, we will open up for Q&A. Be happy to answer all the questions and take as long as we need to get through those. Okay, on this slide, if you notice, there's A, B, C, and D. This is kind of an overview of, now most of you, I'm sure, have looked at the policy, and you'll see these A, B, C, and D coverages. That's how they are listed. And we're going to go right down the line. And again, 99% of the policies are listed this way. We're talking homeowners, not commercial. Commercial, a little different. And so A is the dwelling. It refers to your primary structure of your home. If it's a rental property, it'll be still listed as a dwelling. Now, under the dwelling coverage A, if you look at the green bubble dot at the top there, right, you'll see that under A, there are other coverages that are afforded under A. And these are primarily listed inside the body of the policy or contract. And it's in that verbiage we talked about, the conditions, the additional coverages, et cetera. And under A, you have extended replacement cost endorsements, which kicks up the numbers. And we're going to go through that on the next few slides. You also have code upgrade under coverage A. You have debris removal. And you also have landscaping. So it's not just what you see on the deck page. The declarations page is the page that shows you what your numbers are, what your limits of insurance are for the dwelling, other structures, personal property, and loss of use. There is other coverages that you need to know about hidden, again, in the body of the policy. Other structures, the yellow bubble dot there, that covers separate structures, anything that's detached from the main structure. Things like retaining walls, fences, pools, sheds, cabanas, exterior lighting, things like that, workshops. Again, these are other structures on the parcel, on the piece of land that is not attached directly to your main primary dwelling. Coverage C is personal property. Now, I'm sorry, back to B, the yellow bubble dot, you'll see you may have extended replacement cost coverages afforded there. You also have code upgrades. Again, we're looking in the yellow bubble dot. And then you also have debris removal. The debris removal, if you think about the debris field in a total loss, it's not just the dwelling. It's the contents of the dwelling. It's the other structures. It's the fences, driveways, walkways. All that is considered part of the debris field. So you do have coverage under other structures for debris removal as well. And codes, like we mentioned. The next coverage is personal property, coverage C, and that's the contents of your home. If you could imagine, if we took your home before the loss occurred, and we took off the roof, and we tipped the house upside down and shook it, whatever falls out would be considered personal property. And we're going to go over that pretty much in detail on how that works. And so under the personal property, the dark blue bubble dot, you have scheduled items, and we'll talk about what that is. Extended replacement cost may be afforded there as well. And of course, there's debris removal afforded under that coverage. And lastly, loss of use, the red bubble dot, that pays for your housing. When the home is not habitable anymore due to either smoke or it's a total loss, then they owe you for your temporary housing for the shortest period of restoration. And we'll get into that when we get to that particular slide. And it pays for animal boarding, RV boat storage, extra mileage is covered. And again, renting furniture or leasing furniture, as well as, of course, your temporary residence for that period of restoration. So in general, a summary of your deck page would have this type of information listed as A, B, C, and D. And we're going to zero in on each one of these coverages and talk about how they respond. Now, before we dig into this slide, coverage A, and we're going to go right down the line, A, B, C, and D. For those of you that have a mortgage, an outstanding note on the property, I would urge you to call the Loss Draft Department. This is LOSS, S as in Sam, Loss Draft Department, at the mortgage company, and notify them that the house is perished or damaged from smoke, and there'll be a pending settlement check coming in. Now, let's talk about this for a moment. It's really important. The mortgage company will be listed on your declarations page in your policy, and make sure that the mortgage company that you pay every month is listed correctly on your policy. We find oftentimes that the mortgage company listed on the insurance policy was never changed because the mortgage company was sold to another one, another servicing company, et cetera. And what you don't want to have happen is a huge check comes in for the dwelling settlement, and it's made out to you or your trust or however it's listed as the named insured, and the wrong mortgage company. That check is useless. So it has to go back to the carrier, and you're looking at another 30, 45 days before the check gets cut, so you lose a lot of time. So you want to be proactive, notify the Loss Draft Department of a pending settlement, and ask them a couple of questions. And by the way, before I even get into that, the Loss Draft Department is a little department in every mortgage company, and their sole function is to process settlement checks that come in for fires, floods, earthquakes, whatever the covered peril is under your policy that generates a settlement check. Their job is to process that settlement check. That's their function. And so Loss Draft needs to set up a file on your case so that they know this money that's going to be coming in is not to pay off the note. It's to get it back to you, the money back to you, so you can either rebuild or pay off the loan and sell the lot and do that kind of stuff. So that's their job. And you want to ask them a couple of questions. Number one, find out what their protocol is in an effort to release the money back out to you so you can start the rebuild. Every mortgage company pretty much has different protocols. Wells Fargo, Mr. Cooper, B of A, whoever your mortgage company is with, you want to find out the way that they disperse the monies. Now, they only have what's called an insurable interest on that settlement up to the amount of the note. So an example would be, let's say you have $1 million check for your dwelling, just using a hypothetical number, and you only owe them $600,000. Well, they cannot control the whole million. They can only control up to $600,000. So when that check gets sent to them, you sign it off, and it goes over to the Loss Draft Department. They will put it into an escrow account. Once that settlement check clears, they should be able to cut you the difference. In this example, the check was $1 million. You only owe them $600,000. So they would cut you a check back for $400,000. That's called the unencumbered amount. The encumbered amount, where they have an insurable interest, is the $600,000. Now, let's talk about how that gets released. They're going to want the adjustment figures Usually these are the two documents that they need in an effort to start to release the money back out to you so you can start repairs. So they're going to want the adjustment figures. They want to know, how did these numbers come to be? And they're going to need a licensed contractor's contract on file as well. And once their protocol, assuming that those are the only two documents that they would need, then they would release a third to start the project. So if you have a $600,000 encumbered amount sitting at the lost draft department, they'll release a third. And once you exhaust that, you call them up, say, I need more money released, and they will usually send out representatives to photograph the job to make sure you're spending the money on the project, not going out and buying an automobile or going on a vacation. Again, it's collateralized loans, so they want to make sure that they're protected as well. That's why they're listed on the settlement check. And so then they'll release more money. And that's how it works. But again, notify them, let them know you've got an impending check coming if you already haven't, and then find out what their protocol is to release the money back out to you, not only the unencumbered amount, but how do they release the encumbered amount, which is the one that they have the insurable interest on. I hope that made sense. So that's the mortgage company and how to deal with them. Now let's get into this slide. We're going to use this $2 million base limit, or otherwise known as a stated limit. This is that number that you see on your declarations page, which you were sold. The policy of limit was $2 million in this example. So we're just going to use that as a primary example here. Now, if you notice on the left, the little picture of the house, so $2 million under it, these are the other coverages that are afforded under the dwelling coverage A. You've got the extended replacement cost. You've got code upgrades. You've got debris removal and landscaping. Those are the four sub coverages, so to speak, under dwelling. So we're looking at a base limit in this example of $2 million. Now let's talk about extended replacement cost. The extended replacement cost endorsement, if you have it, sometimes it's 20%, some are 25%, some are 50% additional coverage, some are up to 100%. So you want to find out, this is critical because we're finding that a lot of people may not have enough, even with the extended replacement cost endorsement. So very important to look at what the percentage is. Is it 20, 25? And you'll find it, if it's not on the declarations page listed as a percentage or a dollar amount, then you need to look in the body of the policy under the extended replacement cost endorsement. So in this example, we're going to use that the policy, it gives you 50%. So now we're looking at an additional $1 million above the $2 million. These are all stackable numbers, by the way. Under that, you have code upgrades. You have, the insurance company owes you for what you had at the time of the loss, plus the additional monies it will cost to bring the building up to code. And it's listed as ordinance and law under the contract. So what that is Title 24, for example, energy efficiency, fireproof decking and roofing materials, low drip or low flow rather, toilets, sinks, etc. And so we do find that after firestorms, the codes do change, and they change often. So you're going to have to bring that building up to today's standards. And most policies pay simply 10% of the $2 million. So that's how we got the 200,000. Now, some policies will pay up to 100%. And so again, it's really critical to know what these amounts are stackable so that you know what your all-in number is ultimately. Under code upgrades, you have debris removal, which is 5% typically. And there's some very unique policies that may give you a little more, but usually it's 5%. And that's how we got the $100,000. And again, everything's bouncing off the $2 million. You've got landscaping, and that's 5% of the $2 million. That's 100,000. Now, under landscaping, there's some caveats there. They either offer, you have for example, a limit there of $100,000, but it's subject to $500 or up to $750 per tree, per bush, per shrub. And so you may have 100,000, but if you only have lost 4 trees and they give you $500 per tree, no matter how beautiful or how mature the tree was. That they have these sublimits under the 5%. So you want to find out what that is. And usually that's a low-hanging fruit. You count the shrubs, the trees, whatever you've lost, and you submit. And that's part of coverage A as well. Now, some of these policies have also additional increase due to declared catastrophe. And so you want to know if that endorsement exists. There's only a very small amount of companies that offer this. I can't really mention names, but they're out there. And what it does is it kicks the extended replacement cost up, in this case, from 50 to 100%. So you want to see if you have that extra money available to you in a declared disaster zone or catastrophe. So if you look at the bottom line here, you've got now 3.4 million. You started at 2 million. We found 1.4 million in coverage in this example. So it's really important to calculate your all-in number. And then you kind of divide that. Well, you got to strip away debris removal because that's going to go to the debris removal people. And we'll talk about debris removal further on into the program here. And then you do that, divide that by the square footage, and that's your per square foot price. Hopefully you're properly insured and that you are able to either rebuild or replace. So in essence, this is what coverage A looks like and the subcategories under coverage A. Next slide is going to show you have three options, pretty much. This is how we see it. You have three options under coverage A, under the dwelling coverage. You're either not going to rebuild, or you're going to purchase a replacement property, something that's already built, or you're going to rebuild again on site. And those are your three options. And depending on which one you choose, the policy will respond in a certain way. So we're going to start with the no rebuild option. We're still using the base limit of $2 million. Are you entitled to the debris removal if you don't rebuild? Yes. So there's your $100,000 available for debris removal. Landscaping, are you entitled to that if you choose not to rebuild? Sure. Yeah, you are. You may forfeit the extended replacement cost. Okay, so let's talk about that. The extended replacement cost endorsement has a trigger. So in an effort to get access to that money, it's like a door. You're opening the door to more available benefits, so to speak. And the loss has to be measured greater than 2 million. So the extended replacement cost, you have to perform in an effort to get that money. And I'll get to that in the next two examples. It's a little complicated. I want to make sure we dedicate a moment to that. So again, under the no build column, the extended replacement cost endorsement may be forfeited. Additional increase due to declared catastrophe may be forfeited as well. And then the code upgrade money is forfeited as well. The extended replacement costs and the code have to be incurred. Now, there's one or two companies out there right now that will pay the extended replacement cost and the code without performing, which is kind of stepping outside the four corners of that policy or contract. And that's a management decision. That's just their protocol. So if you've gotten that without performing, that's a blessing. Count your blessings on that. Otherwise, 99% of those policies out there are going to have you have to perform and spend the money on code and extended replacement costs in an effort to get that money. So again, if you look at the no rebuild column, you're giving up some benefits there. Middle column, purchase or replacement property. Look, some folks don't have the wherewithal to wait 2-3 years to rebuild, whether you're up there in age and you just don't want to go through this whole hassle of rebuilding, and it's work. Then some people opt to either pay off the note, strip the land, get rid of the debris, get that certificate of clearance, and then sell the lot. Use that money that you sold the lot with and the money from the proceeds of the settlement, and you go out and you purchase a home that's already built. It's a quicker, more efficient way. For those of you that want to do that, that's an option. So let's go down the column. Base limit, again, $2 million. Debris removal, yes. Landscaping, yes, you're entitled to that. You are entitled to the extended replacement cost endorsement. In this case, again, these are all example numbers, right? $1 million, assuming it's 50% of the 2 million. And if you have the increase due to declared catastrophe, then you would have that available. And your code money is also available if you buy a replacement property. So, for example, if your new property isn't quite up to code like your old property was that perished, then you may be entitled to collect for code there to bring it up to code, or combine all those coverages as well. Lastly, if you rebuild on site, same thing as purchasing a replacement replacement property. You get the 2 million, and you're entitled to debris removal, landscaping, and the extended replacement cost and the code. So again, if you don't rebuild, then you've got some forfeiting of benefits there on this on these 3 options, but you do have these options. Next slide. Coverage B, other structures. Again, garages, workshops, things that are detached, gazebo or anything, again, on the parcel, on the property that's detached, retaining walls, things like that, walkways and driveways, sprinkler systems, exterior lighting, pools, cabanas, etc. Now, you've got a base limit here of 200,000, which is 10%. Some policies pay up to 20% of coverage A, dwelling. So this is where we got the 200,000. You've got the extended replacement cost. You may have that endorsement in there, and you want to know if you have it, because that'll kick up the 200,000. In a lot of the rural areas that my experience has been where, most folks have these big elaborate workshops and 4-car garages and such. These limits under other structures are typically really underinsured. And so if you have an additional structure that's sizable, you want to look for that extended replacement cost if you have it under coverage B, other structures. You are entitled to 5% for debris removal. And also, if you choose to rebuild that garage, that workshop, whatever, the retaining wall, it has to be brought up to code electrically, plumbing, whatever's in there, that's going to be code triggered. And you want to make sure that you're able to collect for that. So we just found, $30,000 more, actually 20, because again, the debris removal money is going to go to the debris removal companies. So coverage B is kind of simple. But that's how that would respond under coverage B. Now, coverage C is personal property. This one's a really tough one. Before I get into this, I want to talk about smoker losses real quick, or not so quick. Smoker losses, for those of you that suffered ash, soot, pressurized smoke, make no mistake, there's a lot of damage there. And I would urge you to think about getting an environmental hygienist in and get the house swabbed and tested. Some carriers are paying for these tests up front. Some carriers are recommending to clean and then we'll test, which is problematic in my opinion. And the environmental hygienist will, I think there are different packages you can choose from. It's not cheap. And if the carrier decides that they don't want to cover it because they can, it's whatever. It's their choice. It falls outside that contract. And I've seen it happen. Be prepared to expend some money. Now, to that I say, what's your health worth? What's your family's health worth? And if you had no insurance, would you still do it? And the answer, of course, usually is yes. My family's health and my health is the most important thing. And so you would do it anyway. So I would urge you to get an environmental hygienist in there and test for heavy metals and whatever carcinogens are floating around, so that if a cleaning company gets established for you you want to make sure they're qualified. A lot of the cleaning companies have day laborers. They may not be the right crew in an effort to clean these toxins. And you want to make sure that the compounds or whatever equipment is used is used properly, and that your house will have a healthy environment again to live in. when it's done. That's really important. And so with that said, let's move on to personal property. Personal property, in this example, we have 1.5 million as a limit. Now, that's your base limit. You have sublimits, and the sublimits are BPP. If you look at on the right side there, BPP means business personal property. Okay. The policy has a limitation for what's considered business personal property. For those of you with a home office or have some kind of business operating in the garage, whatever business personal property you're using and earning an income from needs to be separated on your list. There are sublimits of usually could be anywhere from $1,500 up to $10,000. You got to find it under special limits coverage under your contract. So again, business personal property needs to be separated, and find out what that limit may be under your policy, and that's how that would respond. Watercraft have special limits as well, cash, of course, etc. So you want to see what these sublimits are. There's a lot of mistakes made where I've seen some adjusters on the insurance side tell people that they have special limits, but this on personal property. But what happens is it's for theft, not for fire. So I've seen that mistake being done quite often. So again, you want to make sure that you're looking at that section of the policy so that if the adjuster is saying, hey, your whatever, your watches are subject to a special limit or your jewelry is subject to a special limit, that language in your contract is typically talking about theft claims. Insurance companies hate theft claims, and rightfully so. And so they put limitations on it. And again, this is a fire, and that would exclude that special limit. Scheduled items are jewelry, furs, etc. Scheduled items are when you buy a rider, so to speak, an additional endorsement, if you would, or an additional kind of policy based on the appraisal of the jewelry, for example, and it's an agreed value. So for example, if you lost a Cartier or whatever kind of watch, a Rolex or something of value, and it was appraised at $25,000, then they owe you that because it's scheduled. It means that the insurance company agrees that if that thing's totaled, that they owe you $25,000. So that's what a scheduled item is under personal property. Now, look, make no mistake, personal property is personal. This bucket of coverage is one of the most daunting claims to put together. It's really hard, and it takes a long time. There's a lot of hours put into it. Luckily, the Department of Insurance has now changed the way that the insurance companies are to process personal property claims. They allow you to bulk inventory, categorize it. For example, all the furniture, you list the furniture, it comes out to X, or clothing, X, whatever that dollar amount is, outdoor furniture, X. And so that helps expedite the personal property. Prior to that, you would have had to list, 2,000, 3,000, 4,000 line items of merchandise, and then you have to price it all out. You have to, find out what the condition coding is, and it was a lot of work, and it's still a lot of work. Now, a lot of these insurance companies are giving you healthy, maybe 20, 30% of the 1.5 million in this example advances against the personal property limit. Well, you still got to calculate everything from $1. So if you want more money, then you have to do the work, and it's hours and hours of work to get it done properly so that you can maximize your recovery. This one is a really tough bucket to deal with. We get inbound calls all the time, sometimes 3, 4, 5, 6 months, sometimes up to a year later, where they've thrown in the towel and they say, hey, I just can't anymore. I don't have a life. I'm just constantly working on this personal property list. Can you help? Sometimes we can, sometimes we can't. So keep in mind that personal property is a tough bucket to deal with. And if you want to get paid all your money, you got to make that list. So in the red, you see actual cash value versus ACV versus RCV. What that means is ACV is actual cash value. RCV naturally is replacement cost value. and then depreciation. We're going to talk about this. The way this works is that I hear this a lot. Look, oh, I have replacement cost. I have a replacement cost policy. They owe me all of it, right? Well, yeah, they do, but there's a formula used, and here's how it works. You start with the replacement cost value of the item. And by the way, folks, don't forget to add in the tax, the delivery fee, the warranty, the setup cost. That's a true picture of what you lost. Don't forget the tax, because at the end, if you've got a list that's 6, 7, 800,000, $1 million worth of contents or more, add the tax. That's a lot of money. And so you want to do that. Now you start with the replacement cost value. So let's use a sofa, for example, or a couch set in a living room. And let's say that the replacement cost today, doesn't matter what you paid for it years ago, it's what it costs today to replace, no deals, no discounts. So let's say it's $10,000. That's the all-in number. And the insurance company agrees. Okay, we agree the replacement cost value of that couch set is $10,000. The insurance company has the right to depreciate the value of the couch set because they only owe you the used value until such time as you replace it. And so let's do some math. Again, we're going to start with, they agreed it's $10,000, but it's subject to depreciation for wear and tear, age of the couch, condition of the couch. That's going to drive the replacement cost value of that $10,000 down. So let's say they take $3,000 off that couch. Now you're going to get a check, the actual cash value or the fair market value, that depreciated value, is now $7,000. So now you have $7,000. Well, what about the other $3,000? They're going to hold on to it until such time as you prove to them that you spent the agreed $10,000 replacement cost value. Once you prove that to them, they'll give you your $3,000 back. That's called a depreciation holdback. Now that holds true on personal property, other structures, and your dwelling. Very important to recognize everything's negotiable with the insurance companies, everything. So depreciation is very subjective. They like to play a heavy hand on depreciation because look, folks, they know that you're not going to replace every single item that you lost. That's a fair statement. Most people have 2,000, 3,000, 4,000 line items of stuff in their house, and we tend to devalue what we own. Like the stuff that we don't use anymore, the stuff in the closet, in the back, under the beds, the stuff in the corner of the garage that's just been hanging out there. Well, you're not going to replace all that stuff, pretty much. You're going to replace the essentials, the TVs, the furniture, the bedroom sets, that kind of stuff. So what they do is if they play a heavy hand in depreciating it and you don't replace all those items, well, they get to keep that money. And that's called a holdback. So the way around that is, I would not, first of all, I would never try to get into a cat and mouse, because if you can imagine, you go out and buy something, you have the receipt, and you have to hand it in to somebody at the insurance company, and then they have to scrutinize it, and then you're hoping that they're going to release that money. So the way around that is to inventory everything to the extent that the numbers realistically and defendably, truthfully, come up way above the 1.5 million. Okay, let's use that 1.5 million, assuming you have 1.5 million in that bucket of coverage, and you add up all your categories and it comes out to $2.5 million. Okay, and they depreciate $500,000 off of that 2.5 million. Now you're at 2 million. That's that depreciated value in this example. Well, the 2 million is above the 1.5 million. They commit to the whole thing and you get all your money. No cat and mouse, no handing in receipts. The goal here is to maximize the recovery of 1.5 million legitimately, as long as you can, the numbers, at the end of the day, it's all numbers, but you got to make sure that you're able to defend your position. Now, depreciation, we're going to talk about that. It's not just the age of the item and the lifespan, it's the condition of the item. So if you have a formal living room set, for example, or a guest room that barely gets used, the depreciation on that would be very minimal because the condition of it is in, either excellent or very good condition. It's either going to be in fair condition, poor condition, or excellent condition, and that's going to drive the depreciation. So the goal again is to get the replacement cost legitimately correct at the right number, to minimize the depreciation as best as possible through proper condition coding of each item, and that'll alleviate try to minimize that depreciation. And you want the number after the depreciation is applied to fall above the base limit of 1.5 in this example. That way you got all your money, they've fulfilled their obligation to pay you, and off you go. And you don't have to do any more work handing in receipts. In a perfect world, that's how it works. Is it a perfect world? Of course not. So if the numbers fall short legitimately, and let's say in this example, you got only $1 million in coverage, you got a 1.5 million in coverage, you have a list that comes up to $1 million, they depreciate 300,000, now you're at 700,000, you're going to have to hand in the receipts if you want to get that $300,000 back. So again, to alleviate it, we want to come up above that base limit, whatever your base limit is. I hope that makes sense. So again, replacement cost minus depreciation equals actual cash value. It is recoverable if you have a replacement cost valuation policy, which most of you do. And then you get that money back once you prove to them that you've spent it. Okay. Next one. This is a common inventory questions that we get. Do I need to list every item? Well, look, do you want to get paid is the answer to that. So I would list every item. You want to know what your true losses are above the insurance proceeds. For example, for those of you that are litigating or are thinking about litigation to a degree, then if you have a shortfall in coverage, you got to list all the items. You got to really measure what did I truly lose here. That's where you want to go with that. You want to really get into itemization and properly documenting the loss. Second one is, what is a holdback and how does it work? We just talked about that. So full replacement cost value, holdback, FRV. These are little acronyms that you're going to see on these documents from the insurance company. So it's good that you know them now so that there's no head scratching as you read these documents. Depreciation holdback, again, is that depreciation that they're holding until you replace, otherwise known as withheld depreciation. Certain carriers use depreciation holdback. Others will say withheld depreciation. Again, you do get that back once you prove that you've spent all the money, and that's how that works. How do I get withheld depreciation? Again, you have to send in the receipts. And so I got to tell you, folks, it'll take years off your life. Try not to go down that road. When we're involved, we look to maximize. You got to count the toothpicks. It's that sounds ridiculous, but when you start adding everything up, the devil's in the details. The more detail you provide the insurance company, the less they can argue. Where did you buy it? What are your shopping patterns? How do you shop? Are you just an Amazon shopper, or do you go down to the local in your city and support your local businesses? That all makes a huge difference. It's a narrative. At the end of the day, your buying habits and your buying trends, that all makes a big difference in this whole calculation. Next slide. These are some tools and tips that can help. Just always keep a pad and pen with you at all times. Jot down, there are times, look, I was a fire victim 33 years ago. That's how I got into this. And I got represented and recruited into the business. And I remember what it was like. You can be driving along and you remember, oh, I forgot to list this. Or you're sleeping and suddenly you wake up with this thought about something that you missed to put on the list. Keep a pad and pen with you at all times. Don't rely on the memory bank, because right now you're in the spin cycle. And being in the spin cycle, you're trying to find housing, you're trying to get the kids to school, go to work, maintain some kind of a relationship if you're in one. It's hard. There's a lot of spinning plates going on. So That helps. Keep a pad with you. Draw out each room one by one. If you do a bird's eye view of the home, kind of draw it out, visualize the house and understand what's in each room. Just kind of go through your mind's eye, walk through, for example, walk in the front door of the house, look to the left, what's on that wall, what's on the other wall, what's down on the floor, an area rug, things like that. Just kind of in your mind's eye, walk through the house room by room. And if you draw out each room, it'll kind of jog your memory. Visualize the drawers, bureaus, closets, including the shelves. And don't forget the junk drawers. I always say, the junk drawers have value, believe it or not. I have 2 junk drawers in my home. They probably were $600 to $800 worth of junk in there, old electronics and pens and staplers and all the stuff we throw in the junk drawer. That adds up. Remember, you're trying to get the limit of the policy, and the devil's in the details. Don't forget what was under the bed, up in the closets, all the areas that we all like to hide and stuff we don't use if we're short on space. So don't forget all that stuff. Use family and friends. Usually, family and friends want to help. You can put them to work. Help them research pricing. If they have photographs of maybe an event you had at your home or a holiday, you can ask them if they can download from the cloud those photos. That allows you to look in the background and see what was there. Just again, anything to jog your memory is very, very helpful. Next slide. Last bucket of coverage, we're going to talk about loss of use. And we have not forgot about debris removal. We're going to get to that. So loss of use covers your temporary housing, and it's paid one of 2 different ways. Either you have ALE, which is additional living expense, or you have FRV, which is fair rental value. So we're going to start with the ALE first. Again, this pays for your temporary housing, and you'll either have a dollar value in the policy, or you're going to have a time limit, no dollar value, or both. Now, as most of you are aware, you have up to 3 years. Now, let's talk about that. A lot of people are under the assumption that, well, I have 3 years, but you have a dollar value in that bucket of coverage. So let's say you have $300,000 in loss of use ALE. And you blow through that in 2 years. They're done. They don't owe you any more money because you've blown through the limit of insurance, even though you have 3 years. So the goal here is to make that budget last as long as you can, including the leasing of furniture. So you've got rent, you've got the leasing of furniture, okay? You've got increased mileage under that ALE that you're owed. There's an app out there called Mile IQ. Mile IQ. It's a great little app, and it's about $5 to purchase, and it tracks your comings and goings. And as ridiculous as it sounds, it adds up into a lot of money at the end of the day, at the end of the claim, rather. So if you swipe one way, it's for your routine runs, like if you go to a grocery store. You swipe the other way if it's fire related, and it's listed as business under the app, but you could call it, business/fire related, and it'll track your comings and goings and your mileage. And that's proof and evidence. And it has a summary report. It's great. I use it as well. And the mileage is covered. I think it's right now, it's 0.70 cents a mile. So if you're driving further to work, further to drop the kids off to school, back and forth to the site, those mileage it's covered, and you want to add that up. So again, Mile IQ is a great app to track that. RV and boat storage, that's also falls under ALE. Animal boarding, if you have dogs or cats, sometimes after a firestorm, you're scrambling for a hotel or an Airbnb, but they don't take pets, and those pets needed to be boarded, then that would be covered under ALE. And again, you either have a dollar limit or a time limit or both. Remember, folks, the most important thing out of this is that if the dollar runs out, the dollar limit, doesn't matter if you run out in 13 months, 14 months, and if it's going to take you 3 years to get back in and build the house, they're off the hook. They're done. They don't owe you any more money. You've exhausted the limit of the policy. So again, make sure you look at it as a budgetary number. The fair rental value approach, for example, for those of you with California Fair Plan, they offer fair rental value. So if you had $300,000 in that bucket of coverage and it says fair rental value, what they do is they calculate what your home would have rented for prior to the fire, and that's a number based on comps, and that's your monthly. And so you times whatever amount of time you're out. Now, the way these both work is that it says that the way it responds is they owe you for the shortest, strike that. They owe you for the same standard of living you had prior to the loss. Again, I'm going to repeat that. They owe you for the same standard of living you had prior to the loss for the shortest period of restoration. Now, keep in mind, the shortest period of restoration is the key. So if the insurance company pays you all the money for your dwelling and you just try to sit around and not do anything and you're not moving with, quote, diligence and dispatch, then they can potentially cut that off. Now you have to pay rent, leasing furniture, and a mortgage for those of you that have a mortgage. So be mindful about that. Okay, shortest period of restoration, even though they give you 3 years. Look, the insurance company pays you. Let's say you got $1 million to fix your house, and you've exhausted the limit of the policy, and you're just living off of ALE. They want to stop the bleeding in that account, and so somebody's going to make a decision at some point that, hey, is it fair and reasonable that you're just sitting around and not moving, trying to get this project underway? So that comes up quite a bit. These arguments, and again, even though you have 3 years, it sometimes comes up. It depends on the adjuster. There are, everybody's different in the way they operate. A carrier does owe you for the increased cost due to limited housing. There's usually a run on housing. I do remember in the Paradise firestorm, I think there was somewhere close to 25,000 structures. And I believe this, the Eaton fire and Palisades Malibu is somewhere around 16,000. And there's a mad rush on housing. So landlords will sometimes increase the rental values, and the carrier does owe you for that. Okay. Next slide. So there's a couple of things. We're still going to get to the debris removal that's coming up shortly. How do I ensure I do not leave any money on the table? Well, look, don't talk to the insurance company about your goals. Ultimately, it'll telegraph your position. There's very few exceptions to that. Sometimes transparency is the best practice to put into place. Other times it's not. It really depends on what your goals are. Don't step on the landmines. There are landmines in navigating a complex, multi-million-dollar claim here. Make no mistake. Would you roll up to a roulette table or some kind of a gambling table? We'll use roulette or a card game and put down $1 million and not know the rules? Of course you wouldn't. That's why we're doing these webinars. You want to know what the rules of engagement are and what you're entitled to and how to play this navigation. Understand what you say may impact your recovery. Know your policy. And again, goes back to order the certified copy, read through it, and understand how it responds. Meet with a claims consultant to explore your options. An attorney can help, certainly, or a public adjuster like us, someone intimately familiar with negotiating claims. Look, folks, we do this every day. And if there's an attorney out there that deals in insurance claim settlements, and we're not talking about the kind that are suing the power company. I'm talking about an attorney that deals in claims, preparing, presenting, and negotiating. That's a little different. So you want to consult with either an attorney or a public adjuster, and bounce some ideas. It's a game of strategy at the end of the day. Do I rebuild is another question. Well, it depends what your overall goal is and how your policy will respond to that goal. Do you have a mortgage? If so, what's the balance? And it may play a role in your decision. You're not going to really know how to move forward until all the numbers hit the table. Once those numbers are on the table, you're able to make a smart, informed business decision on how to move forward. What are your restrictions, if any? Code, does it transfer if you don't rebuild? Well, again, remember code and extended replacement cost endorsements you have to perform to get it. You have to spend it to get it. While we're on code, I do want to mention that there are some triggers for code. Code has to be mandated by the building inspector. That's number one. That mandate has to be in place in an effort for the insurance company to pay. And secondly, you have to spend it to get it. So code has those two triggers. Again, does it transfer if you don't rebuild? Is that important, and how might it affect your recovery? If you don't rebuild and you don't spend the money for code, you don't get it. They keep it. It's a windfall for the insurance company. Look, they're smart. They know they played this game for many, many years. They figured it out. And for those of you that want to go, cash out, sell the lot, pay the note, and rent for the rest of your years down by the beach or something, you can certainly do that, but you will be leaving behind some benefits. If I buy instead of rebuild, how do I structure the deal? What upfront commitments are needed? So all these issues come around the decision of, do I rebuild or not? Oftentimes I've seen in the last firestorms, some people have said, look, I live there because of the landscape or the topography, the community. It's all going to be different. And so these are decisions that play a role in whether you rebuild there or you go some other community and buy a built property. Okay. Next one is, I believe that, these slides are really important. So I would urge you to take a screenshot of these. These are the notices issued by the California Insurance Commissioner, Ricardo Lara. These are the latest changes that were made, and some insurance speak and the insurance code sections that they're cited in. Very, very important. I would definitely screenshot these. These are things that have changed recently to help the consumers through the daunting process of major claims. There's going to be, I believe, 3 or 4 slides. So this is one of them. Next. I'm going to pause for a few seconds here on each one. Next. By the way, on the last one, we see fair claims settlement practices regulations. We get calls all the time, these inbound calls, and people are complaining of the adjuster that they're not getting back to them. I've emailed my adjuster 3 times this week. I've called them 5 times this week. They're not responding. What do I do? Well, what you don't know is that they have 15 calendar days after receiving the communication from you to respond. Some insurance adjusters are incompliant and others are not. But it's important for you to recognize that they do have 15 days, folks, to respond. Next slide. Here it is. Okay, let's talk about debris removal. This is one of the hot topics after every firestorm. And it's a little bit complicated. I think by now you all probably have a good sense of it, but I do want to go over it. So should I opt in or opt out of the debris removal program? As you are aware, the Army Corps of Engineers is involved, and their job is to come out lot by lot. I don't know how organized it is yet, but to remove the debris field and ultimately get you what's called a certificate of clearance. The certificate of clearance will come from the building department, and that piece of paper, that certificate is worth its weight in gold. Because, folks, you're not going to be able to rebuild or sell the lot unless you have this certificate of clearance that deems the lot free and clear of hazmat. That's a buildable lot. So should I opt in or not? Well, my answer to that is you got to look at how much money you have available in the debris removal section of your policy. Most people don't have enough. So if you have 30, 40, 50, 60, $70,000 available under debris removal, and your house's square footage could be 2,000 to 3,000 square feet, it's not going to be enough because every lot is deemed hazmat. Hazmat removal is very expensive. And what you don't want is to have a deficit there. So for example, let's say you have $50,000 all in for debris removal afforded under your insurance policy. And you opt in, and they come out eventually and they clear the lot, and a bill comes in 8, 9 months, 12 months later, and the bill is $150,000. Well, your policy only pays $50,000. That's the all-in number afforded, and they get that for the job, and then the difference will be subsidized by the government. So that's a good thing. Okay, and so I would opt in. I think it's a good idea. You do lose a little bit of control as opposed to having a private contractor. We'll talk about that. But look, I would urge you to be on the lot when your debris removal is scheduled, whether it's through a private contractor or through the Army Corps of Engineers program. You want to be there. Look, they could be bulls in a china closet. If you have driveways and walkways that are salvageable and not spalled, meaning damaged and wicked up and all brittle from the fire and the heat, and you want to salvage those, for example, if you're going to sell the lot and the driveway and walkways are not impacted, and those have value, those add value to the land, to the lot price. So you could put sheets of plywood, the 4x8s, 4x12, whatever those sheets are. You lay them down, and that way when the big grapple trucks come over, and they don't damage them. Okay, so you can do that. And I would definitely be there so that you can monitor the debris removal that's being done effectively and carefully. So opting in is a good thing for those of you that have limited budgets, and most people do in this firestorm. Now, for those of you that have coverage that is high in the debris removal, I've seen it up to 200, some have 300,000. It really depends on the base limit of that policy, right? So the bigger that base limit on the dwelling, the bigger the debris removal money is. So for those of you that have that, you can afford to hire a private contractor as long as they're licensed for hazmat removal, because ultimately they're going to have to, pull the permits. They have to show they're licensed for debris, for the hazmat, and ultimately the goal is for you to have the certificate of clearance given to you at the end of this whole thing. And so if you have, for example, $300,000 available in coverage for debris removal, then and your guy comes out and says they can do it for $250,000, you're good. You've got control. You can schedule it when you want. You don't have to, not like the Army Corps where they're doing it at their pace, and you can control the process a little more with your private contractor. So that's how that works. And they usually come out in 2 phases. The Army Corps has come out. They'll remove your paint cans, things like your propane tanks, things that are loose hazmat items. They'll take off the lot. And phase 2 is they come in with the big backhoe and they dig down, and what's left is a hole. Now, here's something to consider too while I'm talking about that. If they dig down beyond 6 inches or a foot, whatever they're digging down, and you're left with this hole in the ground, you got to look at the policy, because the policy may not pay for backfill, because when you rebuild, you're going to have to backfill and compact the soil in an effort to build on that lot. And so, you want to look at the policy and see if they do pay. Most policies don't pay for backfill. So that's something else to consider when looking at the overall settlement and how your monies are going to be allocated. That's pretty much it on the debris removal program. There's my contact information and my email and phone number direct. That's my cell. You can, feel free to, we're going to open up for Q&A, by the way, but feel free to reach out. I've been taking a lot of incoming calls after these webinars, and be happy to do policy reviews, talk about your unique situations, and answer those tough questions you just can't ask the insurance adjuster, because again, these are, sometimes it's a matter of how you're going to strategize moving forward. Be happy to discuss it. There's no cost, there's no obligation, and it'll allow you access to some really good one-on-one consultations. And again, there's no cost, no obligations, folks. And we're going to open up for Q&A. Feel free to use the chat box. Okay, let's see what we got. So we have a question here. My rental home burnt down and my fair rental value coverage is based on the rent my tenant was paying for 1 year, but the rebuild is going to take longer than that. Is there any way to extend the loss of rents coverage like what's sometimes available to homeowners policies? That's a great question. Basically, the rental policy contract is written a little bit different than your homeowners. So there's a dollar limit in that loss of income or loss of rental income under the contract, and once it's exhausted, it's done. And so they don't. If it's 12 months, that's it. That's what the contract says, and they'll pay you the 12 months, and the insurance company's pretty much off the hook. Sometimes you might have a 30-day extension, maybe a 60-day extension with good cause. You'd have to read the loss of rental income or loss of income section of that rental contract that you have or the rental policy. If I decide to rebuild on a different property, are there any complications? I should know about. Also, can I keep the original land or will that affect my claim in some way? If I decide to rebuild on a different property, yes, you can do that. By the way, these benefits, folks, follow you all over the country. If you want to move out of California, which a lot of people have done after these events, I've had clients go to Idaho, Vermont, Texas, everywhere, Montana. Yeah, these benefits follow you, okay? And so that's not an issue. Are there any complications I should know about? They only owe you for what you had, remember, and what it would cost to rebuild where you lost the property. That's important to note. So if it costs you more to rebuild in Idaho, for example, I don't know why it would, but it could. If it does, then remember, they only owe for what it would cost to rebuild where you lost. So that could be a complication. Also, can I keep the original land? Well, yeah, if you pay it off. Remember, if you have a mortgage, you still got to pay the mortgage, even though there's no house there, but you can keep the land. If you don't have a mortgage or you pay off the note with the settlement, you can keep the land until somebody wants to buy it. Certainly you can do that. It really doesn't affect the claim because land is not covered under the policy. Our house is still standing, but it's full of smoke and soot. The insurance company has not approved an industrial hygienist yet, but I'm not sure how to move forward with cleaning without knowing exactly what needs to be addressed, like lead, asbestos, or other toxins. What should I do? Look, I got to tell you, if it were me, knowing what I know after 30 plus years of doing this, I would really want to get an environmental hygienist in there and test, because you get one shot here to do this right. You don't want to move in and then find out a year and a half later your kid's sick or you're starting to feel ill because you didn't do the right thing. This is no joke. They've done studies. I think after the Paradise Fire, pulmonologists had done studies. It's pretty gnarly out there, so don't take that lightly. You want to make sure it's done correctly. If the insurance company will pay upfront for prior to any cleaning, that's great. Now, like I mentioned earlier, some carriers are saying, let's clean it and then let's test it. Well, that's a problem in my world because you're kind of getting rid of the evidence and we don't know if the cleaning company is actually qualified to handle that stuff. How are they cleaning it? What are they using? Sometimes the chemicals used are worse than the toxins themselves. And so you want to know all this up front. If I stay in another home I own while my damaged home is being repaired or rebuilt, can I pay rent to myself and be reimbursed under my ALE coverage? Well, first of all, you cannot profit from a loss. That's what it says under the contract, and rightfully so. You can't be better off after a loss occurrence than you were prior. However, there is a matter of transparency there, and I'll share with you in Santa Rosa, for example, we had some clients clients of means, they had well off, and they owned other properties in the area. And so the tenants had vacated their rental property. They owned a primary residence that burnt down. So they naturally wanted to stay in their own rental property. It's theirs. And with transparency, we explained it to the insurance company that this is the situation. There was a run on housing. And were they willing to figure out what the comp would be and pay for them to stay in their rental property? And they agreed. And so again, everything's negotiable, but be transparent. Another way to look at it is if the insurance company is paying an LLC, for example, your rental property is an LLC, or there's a property management company handling things, the checks are going to the property manager and not to you directly, or they're going to the LLC. It's kind of like you're one arm removed from it. And so again, transparency is the key here. Be honest, be truthful, and explain the situation. And again, it's all negotiable with the insurance carrier. That's how I would handle that. Now the question is, what can I do if I don't agree with the amount the insurance adjuster has come up with for my claim? Well, you have to defend your position. There's always, folks, a difference of opinion. And the only caveat to that is if you're so grossly underinsured that you have gotten paid every dime in your policy, all of it, the extension, the code, and everything, then there's nothing to argue. However, if you find that you don't agree with their numbers, that's fine. You're entitled to make further claim, but you have to defend it. If you can defend it, then they owe it. Remember, you're the claimant. They don't have to be right. There's no law in the state of California that mandates that an insurance company has to be accurate on the measurement of loss. So when you guys get that exactimates, call it the estimate, the numbers, how they came up with that building claim, your numbers for the dwelling, you better look at that carefully. We do find often there's errors, there's omissions. They may be missing windows or adding windows, or the descriptions are wrong. That all impacts the dollars. Sometimes the square footage is wrong. No one cares about your money more than you. So make sure that you look at those documents. Don't take anything for granted. Remember, they don't have to be accurate. You do. You're the claimant, not them. I don't see any other questions. Oh, hold on. Here's a couple. So here's one. What can I do if I agree with the insurance? Okay, so I answered that. Here's another one. If a person decides to purchase a different home or not purchase at all, please take both of these scenarios. Then what is the obligation of the mortgage company to disperse the funds received from the insurance company? So let me look at this a little closer here. If a person decides to purchase a different home, you're entitled to do that, or not purchase at all. So let's do the first one. You are entitled to purchase a different home, that one that's already built. What's the obligation of the mortgage company? Well, look, to disperse the funds received from the insurance company. Ultimately, you can choose to buy another home if you have the funds of the settlement of the personal property and the dwelling. But remember, if they're tying up the outstanding note amount because they have an insurable interest in that, there's nothing you can do. They're going to hold on to that. That money's allocated from the mortgage company to that particular parcel, that lot, so to speak. And so you can do what you want with the money, but whatever the mortgage company is owed, they're going to control that. Unless you choose to pay it off and sell the land, you can certainly do that. I hope that makes sense. So the other scenario is, or not purchase at all. Okay, so if you decide not to purchase a home, this goes back to those three examples of rebuild, not rebuild, or buy something that's already built. So if you choose not to rebuild, that's a choice, and you have that choice. The mortgage company's still going to want their money every month. You're under contract. So you can do that and sit on the land and just pay the mortgage and use the other monies to do whatever you want with. I hope that answers that part. At the moment, the value of the burnt out lot is at least twice the amount of the mortgage, according to current sales and listings. Okay. Well, look, it's up to you. Ultimately, even though the dirt has value, which it does, the mortgage company only cares about the collateralized loan. So they lent you money to buy the land and the structure. If you think about it, the settlement is for the structure, not the dirt. Now, look, you would talk to your mortgage company. You're under contract. It's for the monthly payments. You can either, again, pay down the note, sit on the land and sell it. You can certainly do that. You can pay down the note with the settlement and sit on the land. You can sit on the land for as long as you want. Ultimately, the numbers are all there on the table for you to make a decision, and those decisions will be based on dollars and cents. It's a business decision. Hope that answers it. If a person decides to purchase a different home or not, yeah, okay, we just did that one. That's the last question. Yeah, are there any other questions I can answer? And again, folks, feel free to reach out to me if you want to discuss this further or in more detail. Again, no cost, no obligation. Be happy to spend some time with you guys on one-on-one. I hope this webinar was helpful. We have 2 more to do. It'll be the same in spirit of transparency. These webinars are pretty much the same information, same slides. They're available because not a lot of people knew about it, and as time goes on, the word spreads, and that's why we do a few of them every month. Okay, with that said, again, thank you all for joining our webinar, and I bid you a good evening. And if we don't connect further, I wish you plenty of luck with resolving your claim, and hope that you can get back into a home and resume your normal life. Have a good evening. Thanks again.